Welcome. Today, we're diving into the essentials of compiling a cash flow statement. Whether you're a business owner, an accounting student, or just curious about financial statements, understanding cash flow is crucial. This statement helps you track the movement of cash in and out of your business, giving you a clear picture of your financial health. Over the next several scenes, we'll break down each step, from gathering data to analyzing results. Let's start by understanding what a cash flow statement is and why it matters for every organization, big or small. Cash flow refers to the total amount of money being transferred into and out of a business. It's not just about profits. Cash flow shows the actual liquidity available to pay bills, invest, and grow. Unlike income statements, which can include non-cash items, the cash flow statement focuses solely on real cash movements. This makes it a vital tool for managing day-to-day operations and planning for the future. Understanding cash flow helps prevent surprises and ensures you can meet your financial obligations. Main purpose of a cash flow statement is to provide insight into a company's cash inflows and outflows over a specific period. This statement helps stakeholders assess how well the company generates cash to fund its operating expenses, pay debts, and support investments. By analyzing the cash flow statement, you can identify trends, spot potential cash shortages, and make informed decisions. It's an essential part of financial reporting, used by managers, investors, and creditors alike. Cash flow statement is divided into three main sections: operating activities, investing activities, and financing activities. Each section tells a different story about how cash moves through your business. Operating activities cover day-to-day transactions, investing activities relate to buying or selling assets, and financing activities involve borrowing or repaying funds. Understanding these sections is key to compiling an accurate and informative cash flow statement. Before you start compiling your cash flow statement, you'll need to gather the necessary financial data. This typically includes your company's income statement and balance sheet for the period in question. These documents provide the foundation for identifying cash transactions and adjustments. Make sure your records are accurate and up to date, as errors here can lead to misleading results in your cash flow statement. There are two main methods for preparing a cash flow statement: the direct method and the indirect method. The direct method lists actual cash receipts and payments, while the indirect method starts with net income and adjusts for non-cash items. Most companies use the indirect method because it's easier to prepare with available data. We'll focus on the indirect method in this guide, but it's good to know both approaches. If you're using the indirect method, the first step is to start with net income from your income statement. Net income represents your company's profit after all expenses, but it includes non-cash items like depreciation. To get to actual cash flow, you'll need to adjust net income by adding back or subtracting these non-cash items and changes in working capital. Depreciation is a non-cash expense that reduces net income but doesn't affect cash. When compiling your cash flow statement, add back depreciation to net income. This adjustment ensures your cash flow reflects only actual cash movements, not accounting entries. Other non-cash items like amortization are treated the same way. These adjustments are crucial for an accurate statement. Next, adjust for changes in working capital accounts, such as accounts receivable, inventory, and accounts payable. An increase in accounts receivable means less cash collected, so it's subtracted. An increase in accounts payable means you've delayed cash payments, so it's added. These adjustments help bridge the gap between net income and actual cash flow from operations. The operating activities section shows cash generated or used by your core business operations. After adjusting net income for non-cash items and working capital changes, you'll have the net cash provided by operating activities. This figure is a key indicator of your company's ability to generate cash from its main business activities. Investing activities section records cash flows from buying or selling long-term assets, such as property, equipment, or investments. Cash spent on new equipment is an outflow, while cash received from selling assets is an inflow. This section helps you see how your company is investing in its future growth and expansion. Financing activities involve cash flows related to borrowing, repaying debt, issuing shares, or paying dividends. For example, taking out a loan is a cash inflow while repaying it is an outflow. Issuing stock brings in cash while paying dividends reduces cash. This section shows how your company funds its operations and growth. Once you've completed the operating, investing, and financing sections, sum the net cash flows from each. This total shows the overall change in your company's cash position during the period. A positive number means cash increased, while a negative number means it decreased. This final figure is crucial for understanding your liquidity. The last step is to reconcile the ending cash balance on your cash flow statement with the cash shown on your balance sheet. This ensures accuracy and helps catch any errors. If the numbers don't match, review your calculations and adjustments. Accurate reconciliation builds trust in your financial reporting. While most companies use the indirect method, it's helpful to understand the direct method as well. The direct method lists all major cash receipts and payments, such as cash received from customers and cash paid to suppliers. This approach provides a more detailed view of cash movements but can be more time-consuming to prepare. The indirect method is popular because it starts with net income and adjusts for non-cash items and working capital changes. This method is easier to prepare using data from your income statement and balance sheet. It's widely accepted and provides a clear link between net income and cash flow from operations. In using the indirect method, common adjustments include adding back depreciation and amortization and accounting for gains or losses on asset sales. You'll also adjust for changes in accounts receivable, inventory, and accounts payable. These steps ensure your cash flow statement accurately reflects cash movements. Some transactions don't involve cash but still affect your financial statements. Examples include issuing stock for assets or converting debt to equity. These non-cash transactions are disclosed in the notes to the cash flow statement, providing a complete picture of your company's financial activities. Accuracy is critical when compiling a cash flow statement. Small errors can lead to big misunderstandings about your company's financial health. Double-check your data, calculations, and adjustments. Reliable cash flow statements build confidence among investors, lenders, and management. Once your cash flow statement is complete, it's time to analyze the results. Look for trends in operating, investing, and financing activities. Are you consistently generating positive cash flow from operations? Are investments draining cash, or are they being funded by new financing? Analysis helps you make informed decisions for the future. It's important to remember that cash flow and profit are not the same. A company can be profitable but still face cash shortages if customers delay payments or if inventory builds up. The cash flow statement helps you see beyond profits to the actual cash available for running your business. By regularly compiling and reviewing your cash flow statement, you can spot potential cash shortfalls before they become problems. Early detection allows you to take action, such as securing short-term financing or adjusting spending, to keep your business running smoothly. A well-prepared cash flow statement supports better business decisions. It helps you evaluate whether you can afford new investments, pay down debt, or distribute dividends. By understanding your cash position, you can make choices that support long-term growth and stability. Investors closely examine cash flow statements to assess a company's financial strength. Consistent positive cash flow signals a healthy business, while negative cash flow may raise concerns. Providing clear, accurate cash flow statements can attract investors and support your company's reputation. Lenders also rely on cash flow statements to determine whether your business can repay loans. Strong cash flow reassures lenders that you can meet your obligations, making it easier to secure financing. Accurate statements are essential for building trust with banks and other creditors. Management teams use cash flow statements to monitor liquidity and plan for the future. By understanding cash inflows and outflows, managers can make informed decisions about spending, investing, and financing. Regular cash flow analysis supports effective business management. In compiling a cash flow statement, common mistakes include overlooking non-cash items, misclassifying transactions, or failing to reconcile balances. Avoid these errors by carefully reviewing your data and following a systematic approach. Accurate statements are the foundation of sound financial management. Many businesses use accounting software to help compile cash flow statements. These tools can automate calculations, reduce errors, and save time. Choose software that integrates with your existing systems and provides clear, customizable reports for your needs. How often should you prepare a cash flow statement? Many companies do this monthly, but some may choose quarterly or annually. Frequent preparation helps you stay on top of your cash position and respond quickly to changes in your business environment. In addition to historical statements, it's helpful to prepare cash flow projections. These forecasts estimate future cash inflows and outflows, helping you plan for upcoming expenses, investments, or financing needs. Projections are essential for budgeting and long-term planning. Scenario analysis involves testing how different events or decisions might impact your cash flow. For example, what happens if sales drop or expenses rise? By modeling various scenarios, you can prepare for uncertainties and make more resilient business plans. Cash flow ratios, such as the operating cash flow ratio, help you assess your company's liquidity and financial health. These ratios compare cash flow to liabilities or sales, providing valuable insights for management and investors. Regularly monitoring these ratios supports better decision-making. The cash flow statement is closely linked to the income statement and balance sheet. Changes in these statements affect your cash flow and vice versa. Understanding these connections helps you see the bigger financial picture and ensures consistency across your reports. For small businesses, cash flow management is especially important. Limited resources mean that even small cash shortages can cause big problems. Regularly compiling and reviewing cash flow statements helps small business owners stay proactive and avoid financial stress. Startups often face unpredictable cash flows due to rapid growth and changing markets. Compiling cash flow statements helps founders track runway, plan fundraising, and make strategic decisions. Staying on top of cash flow is key to surviving and thriving in the early stages. Large companies use cash flow statements to manage complex operations, investments, and financing activities. These statements help executives allocate resources, assess performance, and communicate with stakeholders. Accurate cash flow reporting supports transparency and accountability at every level. If your business operates internationally, compiling cash flow statements can be more complex. You'll need to account for currency fluctuations, different accounting standards, and cross-border transactions. Careful tracking and clear reporting are essential for global operations. Compiling cash flow statements can also support tax planning. By understanding when cash is received and paid, you can optimize tax payments and avoid surprises. Work with your accountant to ensure your cash flow management aligns with your tax strategy. A cash flow statement is a valuable tool for budgeting. By comparing actual cash flows to your budget, you can identify variances and adjust your plans as needed. This ongoing process helps you stay on track and achieve your financial goals. Strong cash flow supports business growth by providing the resources needed to invest in new opportunities. By regularly compiling and analyzing cash flow statements, you can ensure your company is ready to seize growth opportunities as they arise. During challenging times such as economic downturns or unexpected expenses, cash flow statements become even more important. They help you identify problems early and take action to preserve liquidity. Effective cash flow management can make the difference between survival and failure. Compiling cash flow statements isn't a one-time task. Make it a regular part of your financial routine. Continuously look for ways to improve your processes, reduce errors, and gain deeper insights. The more you practice, the more valuable your cash flow statements will become. There are many resources available to help you master cash flow statement preparation. Books, online courses, and professional organizations offer valuable guidance. Take advantage of these tools to deepen your understanding and stay up to date with best practices. Let's recap the key steps in compiling a cash flow statement. Gather your financial data, choose your method, adjust for non-cash items and working capital, complete each section, reconcile balances, and analyze the results. Following these steps ensures your statement is accurate and useful. Compiling a cash flow statement is an essential skill for anyone involved in business or finance. It provides a clear view of your company's liquidity and supports better decision-making. By mastering this process, you'll be better equipped to manage your finances, plan for the future, and achieve your business goals. Thanks for joining us on this journey to cash flow mastery.